Hey guys, welcome back to the channel. This is Future Trading with Mike. Today is Saturday, February the 19th. Yes, it is not a trading session day where I'm trading and recording my trades or my session to post to the channel. But what I have in store today is a topic that I want to talk about because I get a lot of comments surrounding it or a lot of messages. But first and foremost, let me always start off by thanking the subscribers. If you've already hit that red button, that subscribe button, thank you for doing so. And if you are a subscriber currently and have not hit the post notification, the little bell icon, please do so that you never miss one of the uploads. I know you subscribe for a reason, so go ahead and take the do that second step and hit that bell icon so that you never miss one of the uploads. If this is your first time watching one of the videos, well, you can go back to the channel and watch. I have 150 plus videos. I'm just a live price action trader. I trade just a simple strategy, pullbacks to support resistant areas, particularly supply and demand zones, and simple strategy that allows me to profit in the market each and every day. I do not like complex things. I'm a very simplistic person, so I like simplicity in my life and everything I do that surrounds me. So this simple strategy works, and it works well. Okay, so if you're looking to maybe possibly learn, then follow the channel, hit that subscribe button, that little red button, and hit that little bell icon so that you never miss one of the upload. A little bell-shaped icon next to the subscribe button. So in today's video, I just wanted to talk about, I guess, a hot topic in a sense that most people have questions about and probably lose a lot of money behind this, and that's where to place your stop loss. You guys, some people, I get emails, or not emails, but messages stating that, or comments on the channel that say that, how come you don't put a stop loss in place? But it's everyone's fair right if they want to choose to put a stop loss or not. Some people may feel like because you're not putting a stop loss, you're not actually trading or live, whatever the case is. That's not true. There are people who are experienced, who are professional enough to and know how the markets actually move. And when I say the markets actually move, that means that there's somebody, that there's a bigger being that, or higher being that moves the market, and that's the institutions. Okay, they've gotten hundreds of millions of dollars to inject into the markets every single day. So they are the ones that can yank and pull the market any kind of way they want to, and we as retail traders just want to trade along with them, which you should be doing. Don't trade against them, because if you trade against them, then you're going to lose. Okay, may work for you a little bit. You're thinking that you're trading correctly and doing the right thing, and then it stops. All that stops. Okay, then you start losing money. All right, so stop losses, that's up to you. How tight of a stop loss, how loose of a stop loss, that's up to you. I particularly don't use a physical stop, meaning that I actually manually place a stop in the market as soon as I enter my trade. Like if I hit buy bid or buy ask or buy market, or the opposite on the sell side, or whatever the case is. Once I do that, I don't immediately go in and hit a stop loss. Set a stop loss, or even set a stop loss with an ATM strategy, which I don't use ATM strategies. But what I'm trying to say is there's a reason behind it, because if you ever heard of the, just the people talk about my stop got ran. Well, yeah, they hit your stops. They hit your stops. That means the institutions. That means they're searching, and they know what people's stops are sitting at, okay? Because they know how traders are going to trade, okay? So that's what this video is surrounding today. One, to talk about, I'm just telling you right now, basically why I do not trade, or not trade, but why I do not put a physical stop in the market. I have a mental stop that before I even enter a market, I know exactly where I'm going to get out at if the market comes back against me, or it doesn't go in my favor or direction, whatever the case is. I know exactly what that is, and it's always at a swing level. Okay, it's always at a determined or defined swing level that has been created once price gets back to an area of supply and demand. Okay, so we're going to go ahead and jump into the video. And I'm going to tell you, this is the reason why I do not place a stop loss. And I'm not recommending that you do the same. You trade at your own risk. You trade according to your plan. You trade the way you want to trade, because everybody's situation is different. Their capital is different. The money they have to put into the market. You trade. Now, the old me used to trade and put a 10, 12 tick stop loss. But the markets are always evolving, so things are always changing in the markets, and you have to be able to adjust when the market changes. Okay, so but the biggest thing is trading along with the institution. So let's take a look at a couple examples, and I'm going to show you why I do not particularly set a stop loss. Okay. Okay, so I'm gonna show you an example. Okay, and typically this surrounds areas of like support and resistance. You know, because and you're gonna see what I'm talking about. Why it's important to trade those supply and demand zones and wait for price to get it, move back into those areas or retrace back to those areas. So when price pushed up here and then pulled back and it pushed up higher, breaking this little broke this high right here. So now we got to swing to the upside. Then price turns back around and starts swinging, making lower lows and lower highs to the downside, in which it breaks this structure right here, breaks this low right here. Okay, so when price swung down here, pulled back, and then pushed lower, it took out this low here, right? So what you want to do initially is wait for price to pull back or basically trace back, okay, to this area right here. Okay, so when price push lower, then turn back around, pull back to this area. Okay, I'm gonna show it to you. It retraces back. Okay, now it pretty much comes back with just a few ticks. It almost hits resistance. Some people would wait for it to come back a little higher, whatever the case is. But just say, for instance, right here. Let's show it to you. I'm gonna use the arrows. Okay, some people have a hard time seeing this. So this is when price pushed up. This is just price making a higher high, high low. Okay, then price turns back around. What does it do? Low, lower high, and lower low. Finally, and it breaks this area right here, this low right here, and then it continues going down, right? What we want to do is wait for price to pull back to the area of resistance, right? Which is it pulls right back almost to the area of resistance, a few ticks. Some people, okay, some people that don't have enough experience in trading, they would, you know, oh, okay, price is almost there, just maybe 2 or 3 ticks away from hitting the area of resistance. We're back at this area, this level right here, you know, this what they would think would be a level right here, okay? And what they would do is the moment this candle goes moves to the downside and turns red, flips, they're short. Yes, you can be short for a few. You know, if you're short, you may pick up a few ticks, and it could be just luck there, you know, by chance, whatever the case is. But I don't like trade. I do not like to trade the areas just right at resistance. Okay, I like to take the trade back into the area where this would be supply sitting up and tucked away into the area. Okay, so what happens is if you took this trade right here, went short right here on this pullback, say to resistance in a sense, like right here, we're a few ticks away from it, maybe 2 or 3 ticks. Okay, but if you took that, sometimes price won't always come back and hit it to the tick. It won't hit that area of resistance to the tick. But I'll just pass that trade up most times because I like to see it actually come back and actually hit those levels, those zones to the tick. If it doesn't, 9 times out of 10, I'm not going to be interested because I don't want to put on the risk. Okay, so what happens is that price retraces back right here. Okay, you get into a trade. Okay, at this point right here, you may start making a little profit, a few ticks, whatever the case is, but this is liquidity. Okay, all right, when price pulls back, okay, it knows where it wants to go. The institutions, they know traders are going to jump in right here, okay, at resistance if this flips and turns red. You jump into that trade, what do? They let you get a little bit, they turn it back around, push the market higher, pull them back into the area of supply within the swing right here, and they stop you out. This is what frustrates the traders the most is jumping into an area on the pullback to an area of supply, okay? I mean, excuse me, to an area of resistance or support, all right? They think that, price is pulling back to an area of support, resistance here. Sorry about that. And they get into a trade. Boom, the moment it turns red, the candle turns red, and they get stopped out. You got to understand because this is how their shopping stops is what they're doing. They're shopping stops. They're pushing the market higher, you know, they're retracing it back, bump back against resistance, boom. You get into a trade, they know, they see your stop sitting there, turn the market back around, collect your money. All right, then what happens? Price pulls back a little higher into the area of supply. Then what happens? They turn the market, flip the market to push it back down in your intended direction. And then it's like you're very upset, you get frustrated because not only did you get into a trade that started to go in your favor, but then it turned back around, got stopped out, pushed back just a little higher, okay, to run your stop, and then they shop the stop, and then they turn the market back around and move right back in your favor. And you say, wow, if I really knew how they actually work, how the institutions actually move, the game they actually play, then I could have waited and made really made my money. Okay, and that's what they do. They know how traders are going to trade. They know that traders like to trade right at areas of support and resistance, pulling back to. And then sometimes they'll the market will trace back to this area of resistance, say right here, and then it will stop there. It'll bounce and then push back lower. But the best opportunity, I'm telling you right now, just based on back testing and looking for studying the markets for years, just following and trading for years, knowing how the institutions trade, just getting the inside perspective and just trading it every day. Guys, they like to pull retrace the market back to an area where the selling really a bulk of the selling actually started, originated. Price pulls down, selling here. Pulls back a little bit, and then a lot of selling is starting to accumulate. Sellers are starting to step in. Boom, selling, selling, selling. Okay? Don't get it right here on the move to the downside, on the retracement right down to the downside. Get into it where the sellers started putting the positions on, and that was back at the area of supply sitting right here. But let's go over another example. Okay, we'll cover another example here. So let me clarify something too, because I forgot to actually just kind of explain this too about the stop loss. So most traders are right here, right? When the price pulls back to the area right here, we have this little arrow horizontal right here. Okay, you're back to the area. All right, a few ticks away from just a tick or two, a couple ticks away from actual hitting the area of resistance. Okay, they get into the trade like I said right here. Okay, you're placing your stop right there. At the top of this little high right here. So if you get into a trade, that candle there turns red to the downside, you're placing your stop right here. And then what happens? Okay, if I place my stop right there, they're going to push the market down, or the market just goes a little lower as the game they play to get you thinking, oh, I'm in a good trade. Then they turn back around and they run your stop right there. The stop is right there. Trust me, traders are putting their stops right here. Okay. That's why, years back, I would place my stop, give at least 10 to 12 tick breathing room. And you have to give a stop breathing room. If you give such a tight stop at 4 to 6, 8 ticks, they're going to hit your stop most every single time, okay? Now, I understand everybody has a different situation when it comes to capital. They don't have much they can risk, whatever the case is. But I recommend that you take some time to really understand and study, go back and look at some examples and see what I'm talking about. So I put my stop right here at the back end of this little move to the downside. Once I enter the trade, they turn the market back around, they run my stop, okay? And then I'm stopped out, lost my money, all right? So let's go ahead and look at another example here where I can show you kind of the same situation, all right? And the reason why I don't put my stop right at my entry point, where I get in at, right behind it, on the back end of it. Okay, so let me show you another example here where I'm talking about, okay? So price pushes lower here. Let's go ahead and kind of draw it out. Let's say price pushes lower, okay? Makes a low here, forming a swing to the downside pretty much, okay? And then we have another little low here, a high, or a lower high, and then a lower low, okay? So this is price action moving to the downside, okay? Then price turns back around, and what does it do? It pulls up, okay? All right, pulls back, and then basically what it does is, let's take this part here off, okay, because I want to show it to you the correct way. With this candle here, it just pulls up. We're looking for to break this area right here, this little high right here at 44.08 or 44.09. All right, so then let's grab another arrow here. Then it does a pullback, and then it pushes higher, right? So what we want to see price to do is pull back, to an area where price, broke market structure and made structure to the upside. So as it pushed up here and then it pulled back, okay, with candles that closed to the upside and pushed up, we have a swing to the upside, okay? All right, take it out, market structure right here, this little high here, as well as breaking structure to the upside, meaning making a swing where it's breaking this high right here as well on the swing to the upside. Then it pulls back. And what does it do? It pulls right back to the area of support, okay? Another example of the reason why I don't do what I just explained to you. Because if I take a trade as soon as price comes back to the area of support right here, okay? That candle flips green, what happens? You're into a trade. Your stop is right below that candle right there, right? All right? 1, you put a tight stop loss right at the end of your entry point, okay? 2, You enter at an area right at support. The top end is right at the top end of support. What happens? It may go 1 or 2 ticks in your favor. The market continues pushing lower, busting through your stop right here. You had the end of this candle right here, and moving on down to the area of where? Back into the area of demand, which is right here. So if you enter right here on the pullback to support versus waiting for price to pull back into the swing, tuck back into the swing to the area of demand, and then looking for an opportunity, you got stopped out. That's the reason why I do not put a physical stop, because the institutions, they know your stop is right there. They know traders that do not have much experience are putting their stop loss right there, and they fake them out. Market pushes higher, they push the market lower, back into the area of supply. Boom, what happens? They turn the market back around and push the market right back in your favor. So you were trying to go long right here at support, right? And putting your stop right below that area. Market pushes a little higher, breaks through it, they shop your stop, boom, collect your money, pulls back a little lower to the area of demand. I'm sorry, if I said supply, I'm sorry, guys. I'm going to say demand. Demand right here, not supply, but demand. Okay, then they accumulate more positions, and more buyers step into the market, and the market actually goes up as you thought it was going to do, as you wanted it to. Okay, so this is two things. That's why I don't put a stop right behind my entry point. Okay, because I know, especially if I'm trading off supply and resistance, because I know there's a 99.99% chance that they're going to bust through right into that stop. Okay, and I'm a loss. I got a losing trade then. So, and then, two, that's the reason why I don't trade right at support and resistance. I wait for a price to go back into that area of supply or demand. In this case, it was demand right here. I cover that one more time for you. I'll blow this up a little larger so you guys maybe can see this. All right. This area right here, this is up to 12 range chart. Price pushes lower, low, lower high, lower low. All right. Turns around, pushes up, makes a high, pulls back, boom. Okay. Pulls back, pushes higher, flips higher. Got to swing to the upside now. Price is breaking structure here, and then it's breaking structure on the upside, breaking this high right here as the swing is formed. Pulls back to the area right here at support. What happens? Boom. Price hits it. Green candle, green light. Most traders are going long, putting a stop right at the back end of that candle right there, which is their stop loss. Pushes up. Boom. Pushes lower. Stopped out. Got shot. Their stop got shot. Price pushes what? Maybe, let's see, 44.07 back down to, just to say 44.03, 44.02 here, 44.03, 4 points, 4 points, and then it turns back around and goes right back in the direction you wanted the market to go into. So I'm not telling you how to trade, but to me, I trade supply and demand zones because they're more impactful. I'm getting in. I want to get into a position once price pulls back to the area, because this is where a lot of the positions for the buy, where a lot of buyers step into the market. I don't want to get right here at the top end of the swing, right here. I want to get back in the lower end of the swing where all the buying really started happening before it started pushing up. So I want price to come back to that area, all right? Then I'm safer, okay? I don't want to put the risk on right here at support. Okay, I want to put the risk more so on when price pulls back to this area of demand. It just makes 100% more sense to me, guys. Study it, back test it. I'm telling you. So that's the reason why I do not carry a short stop loss or put a tight stop loss in the market right there. So where would my stop be at? Let's cover that. Okay, so in this instance right here, price pulls back. I see it pulling back to the area of demand, right? Okay, once I'm into the market, it could have been here, it could have been here, but excuse me. The trade should actually take place. I'm gonna show you where trade should take place at. You should be getting to the trade. Let's see, price pushes up, pulls back. In this instance right here, I really want to see price close above. Let's see here. Yeah, really right above 44.08, somewhere around there. And then get into a trade. So really I would be putting my position on probably the back end of this candle right here. Okay, right here. All right. So basically my stop will be like below this area right here, below this candle right here on the move to the upside. And then you don't get stopped out. You get what I'm saying? even if you put your stop, you got into the trade right here, which I don't recommend you doing because you want to wait for some type of rejection reaction first. When price pulls back to the area of demand, just because this candle here closes green, you kind of want to wait for some better confirmation. Okay, I mean, the price may push up here, and then the moment price retraces back down here, and then pushes up green again with the second candle here, you can go long there with your stop right below this area here. Price never comes back that low. Price never comes back that low. Price never comes back that low. See? That's what I'm talking about. That's how you don't get stopped out. So that's if I'm putting a physical stop loss. Now, if you put a physical stop loss, then be smart about it and wait to price to pull back to those areas of supply and demand, but don't set it like right a tick below the, the candle on which you go long at. Give it a couple ticks breathing room, like I said, 10, 12 ticks, maybe 8 ticks. I'm not telling you that to do that, but I'm just telling you that you've got to allow your trade to breathe, okay? If you don't, you're going to get stopped out over and over again. So I think that's the reason why like a lot of beginner traders lose so much money and they bust their accounts time and time again, is because if they're putting physical or hard stops, then they're not giving them time, room to breathe. That's why I do not do it. If price was to, once I got into the trade in this area, and then it turns back around, pushes up, turns back around, and takes me out, right here is going to be right below here. Like I said, it's going to be my stop. I'm going to jump out the market, okay? But I'm not going to put my stop. I know if the market turned back around, let's say it does this right here. It comes down here, I get into the trade either there or maybe here, whatever the case is. But really, I want to get to it right at the close of this candle right here. Say more so. All right, so then price does that. I'm into the trade, and then it pulls lower and breaks right below this area. I'm not going to jump out as soon as price breaks right below 4402, guys. I'm going to give it a couple of little ticks there, maybe so, whatever the case is. That's just me. That's how, because I want to see, for one, if they're going to come back down here and test this area again. If it came back lower, okay, and a red candle close to the downside, breaking below the low here, I'm out. I'm out for sure, because I know that at that point here, it's broke this low right here. It's broke this low on the swing to the upside, and if it turns back around and does not go, see, like right here when price pushed up, eventually came back down. The candle closed below this low right here, red candle, boom. So, if you were one to hold a position to the upside once you got into the trade, and then made your profit or whatever the case is, or start making money, don't let price come right back down against you on the move back down to the downside in this red candle close to the downside, because then you lost all your gains thinking that maybe price is just going to pull back to move higher. Okay, so start taking off your positions as price starts moving higher. Okay, so just like I said, if price was to turn back around from the moment I got into my trade, say around this area, it comes back down closer to the red candle to the downside, right below this low, I'm out, guys. I'm completely out of the market. Okay, so hopefully that kind of sums up some things about stop losses, why I don't put an actual hard stop on my particular trades, because I know how the market's going to move, and I'm not going to be trading right at support and resistance areas, because to me it don't make any sense, because I know most times they're going to bring price there to shop stops and collect money and move the market back in your favor, the intended favor or direction you knew the market was going to move in. Okay, so I'll show you another little example here. Price moves to the downside, right here. Okay, push down, low, lower high, lower low. Turns around, bounces. I'm not sure what's still left over there. Don't really care at this point. But then it turns back around and takes out market structure, takes it high out there. Pushes up, pulls back, boom, breaks higher. So it's breaking structure to the upside and taking out market structure to the left side, which is maybe this little high right here. So price pulls back. If we got into a trade, like say for instance, like right here at this red candle right here, which is support, okay. Like I said, sometimes price will come out to area support or right at resistance and bounce there and push higher or push lower, whatever the case is, depending on what's happening in the market at the time. But in this case here, it comes back down to give me a second, guys. Oh, here we go. Retraces back, okay, and it actually comes lower. It doesn't stop right here. It doesn't stop right here at the area of support. it actually pushes lower, which is maybe where we at. It pushes to 44, 42 and a quarter, which is only let's see, 2 ticks. Yeah, 2 ticks away from demand. Okay, so to me, that's an area of demand, no doubt about it. Okay, it's testing that area. I'm interested at that point. A tick or two away from demand, definitely so. Right here, let's show it to you. Right here, this is demand. We're talking about just 1 or 2 ticks away. I'm in. Okay, so it's already pulled back further than just the area of support right here. This whole area is support, but I don't want to see it hit right at the top end of the support. I want to see it come back into support, hitting in the area of demand. Now it does. It comes back into the area of demand. Okay, so all right, I'm interested in going long at this time. I enter long the moment the green candle breaks above, meaning basically breaking back above this little swing right here. Okay, it breaks back above. At that point, I'm long. My stop, if you put a hard stop here, um, you know, when you're trading areas of supply and demand, the probability of it going in your intended direction is a lot higher. So you can put a good stop in place, a couple, maybe, like I said, 8, 10, 12 ticks, whatever the case is, right behind this green candle. And you see, where are you going to take the trade to? Back to the high right here, to the top right here. Boom. If you got into the move right here, close this candle right here, that's 45 and a quarter. Back up to this area right here, you're talking 45, 50. That's like 5 points right there. That's a 5-point move, okay? Great opportunity. Price pulls back to demand, and that's what I'm talking about. You put your stop right here. Does it come back? Yes. If you let it come all the way back to your entry point, which is a no-no, without taking any positions, then you know you lost because you lost on your own terms. Is what I'm trying to say. Like, you start taking your contracts off, you start taking profit to areas that you know where price is going to bounce at. I get into a trade right here, I know price is going to react right here at the tops. Okay, no doubt about it. All right. But if I turn back around, if the market turns back around, I'll let it come back to my entry point, and it actually breaks a little lower back to basically the second opportunity. Guys, that's a no-no there. I would not do that. Okay, I start taking my positions off as price is moving higher, and definitely at this area right here. If price comes back to this area again, would I be looking for an opportunity to go long? Possibly, yes, because this is actually a double top. I don't trade those type of things, but double tops, double bottoms. But when I see price pull back or make a double top and come back to the area of demand again, it rejects that area again. This green candle closes right here to the upside. I'm into the position again. I trade again, back to the upside to the area of the highs right here. Okay, simple as that. And that's how you trade it. But you can put a physical stop if you like to. I do not, because I know been trading enough to know exactly what price is, what it's going to try to do, and I know the game they're going to play. The markets will play, the institutions will play. So there's no point of me wanting to try to lose my money. So that's why, if you're a beginner trader, then maybe you need to practice putting the physical stop, but give it room to breathe. Okay. All right. Everybody trades differently. Just because somebody hasn't put on a physical stop does not mean that they're not trading live, or that does not mean that. Some people are just, that's the way they trade, because they're comfortable, because they know how the market moves, because they know enough about the markets that most people don't know about. And a lot of times, people who don't know much about the market, they always got something to say. Oh, that person's not trading real because live, because they're not putting a physical stop. They're not. That's a bunch of BS. Okay, that's not true at all. All right, everybody's trading style is different. According, you guys, just please don't be bashing people or bashing anyone because of something that you're trying to learn, and that somebody else told you or taught you, that if you see people trading around stop loss, they're not trading the right way. No, that's not true. That's not true. It's all about capital, what you have, the risk, and how you actually trade, and with the experience of knowing how the markets actually move. Is bottom line. I'm ranting and raving too much. I'm going to go ahead and close this video out. Hopefully it was valuable. Hopefully you got something out of it. Hopefully it answered your question about how or why I do not actually put hard stops. I have that mental stop. I just showed you when I enter a trade. Where I enter a trade, like right here, if I'm into the trade right here, my stop is below this area because I know it's at an area of demand. I'm not placing like a tick away, but I do know if price breaks below this, my stop is below this candle right, this green candle. Not meaning I'm gonna put it right here, a tick right below or at the end, back end of that candle there. The moment a red candle breaks below this green candle, comes back and it breaks below this green candle, I'm out. Okay, so that's how I do it. The moment the trade comes back in the opposite direction and that candle, if it was moving to the downside, closes below that green candle, I see a red candle close below that, I'm out. All right, but I'm not gonna let price come back against me like that. Okay, so that's going to do it. Hopefully, you guys found some valuable information or found this content valuable. Hopefully, answered all the questions you have surrounding the stop loss, and then probably even gave you even further more information as far as trading supply and demand zones and how to trade stop losses accordingly. That's going to be it, guys. I'll see you. Monday is actually a holiday. It's President's Day. It's a federal holiday. Banks are closed. Early closure on the exchanges on Monday, the equity markets, and I guess probably all the other markets as well. So I will be back to trading on Tuesday. I may drop a video on Monday, just I don't know, surrounding a particular topic. Just depends. We'll see. But today's Saturday, so I gave you another video, and hopefully you guys found it valuable. I'll see you guys next week. Be safe for this weekend, and going into the next week if you're trading, please be safe. Okay. See you then.